This week on the Art of SBA Lending.
Charlie Munger, Warren Buffett's buddy, always said, you show me the incentive plan and I'll show you where this business is going. Baseball, 400 Hall of Fame. Basketball, 65% Hall of Fame. Our business, if you're not over 99, the regulators are all over you.
Yeah.
Do you let them do that in the middle of the day? And I said, Kelly, I trust them and I love them.
In 2020, the banking industry was forced to accelerate into the future, and now there's more innovation than ever before. And many of my colleagues are embracing these tools, and they're winning. But the banks that are slow to adapt, well, frankly, I'm concerned. Here's an example. Bank A uses Lumos and has over 1 billion data points at their fingertips that allow them to, within seconds, access all this data. Local economic data, industry insights, even a predicted expected loss. And Bank B, well, their underwriter spends hours Googling it. Which bank do you think is going to be winning 5 years from now? Guys, we can finally make credit decisions using actual data. Let Lumos take your small business lending to the next level with cutting-edge analytics by going to lumosdata.com and scheduling your demo today.
Well, Chip Mahan, thank you so much for sitting down with me. I appreciate it. So Kay was nice enough to walk me around campus today, and I'm just wondering, do you ever look at all this, look at all these employees and just think to yourself, how did I get here?
You know, when I walk over here, I think about our mission, which is the American dream. We have the best job in the history of the world. Taking a government guaranteed program, giving capital to people that probably couldn't get it any other way to achieve their dream. It's the greatest business in the history of the world.
It really is. And you, the brains behind a lot of what this is. You started the bank in 2008, I believe.
That's correct.
I'm curious, what's it take to start something from scratch, set your sights high, truly disrupt an industry? What are those ingredients that founder or that founding team need to pull something off like that?
So I'll tell you a little story. So in another business, the venture business, a guy named Gene Ludwig and I started in 2019. So Gene is a dear friend and just a wonderful human being. Gene went to Yale Law School with the Clintons. And in 1992, they named him comptroller of the currency. So he started a couple of businesses and then came here and said, we ought to start a fintech company. So we raised $1.5 billion from 70 Macs to invest in primarily fintech startups. And so my real answer to your question is, one of those CEOs and founders came to me the other day and said, Chip, I'm tired. You can't be tired. You're the founder. This is your company. No matter what up or down, you have to put this company on your back and take it to the heights that you envisioned when you started the business. So I've just been blessed with the best partners for the last 52 years in business, and you just find a way no matter what happens. I mean, evidence this company, right? So we filed our charter with the FDIC on the 1st of April, 2007. I had started 2 other banking companies in my home state of Kentucky. And it was a piece of cake. You just filed an application, 90 days, you got the charter, put up a couple $1 million in your way. This took 1.5 years because the FDIC didn't like what we were talking about. And we almost hit for the cycle, right? So you're going to start a bank in Wilmington. You're not going to have any branches, so you're not going to collect core deposits. You're going to make only one loan to a veterinarian, so you have concentration risk. Now we're rounding second and headed to third, and most all your loans are out of area. So they didn't like any of that.
Sure.
Right? So finally, they succumbed. The regulators never succumbed. They're undefeated, untied, and unscored upon. But we got our charter on May the 12th, 2008. And you're too young to remember probably what happened in September of 08.
I've heard stories.
But the world came to an end. So we couldn't make a loan. the capital markets are fundamentally shut down. So like now, government shutdown, right? We're used to this. You just power through whatever curveball the business world sends to you.
So you got your charter at this around the time the secondary market kind of went away because of the Great Recession. So what do you do at that point?
Pray. The head of the FDIC in Atlanta, to whom we reported, called me in March of '09, and she said, "I want you in my office tomorrow." So I took my co-founder and technical genius, Neil Underwood, with me, and we sat in her office. And federal banking regulators are interesting. They don't blink. They just kind of stare at you. And she stared at me and she said, "Mr. Mahan, I want you to sell or liquidate this bank."
Oh, wow.
And I said, "Ma'am, we have $140 million worth of loan commitments to veterinarians. And you got to do what you got to do, and we got to do what we got to do." And then we got in the car to go back to the airport, right? And my partner, Neil Underwood, who likes instant feedback on every meeting, looked me in the eye and said, Mahan, on a 1 to 10, how did we do?" She told us to liquidate the bank, Neil. We didn't do very well.
Yeah.
So we hit that curveball, and here we are.
Wow. So 08, 09, SBA industry is kind of starting to rebuild, barely. But before all that, the music stopped, as they say. CIT was one of the most dominant SBA lenders in the industry. I think they reached $1 billion in originations and had 100 BDOs all over the country, centralized processing, paying big checks to the BDOs. And that was sort of the model that was kind of crystallized and perfected. You went in a totally different direction. Why'd you throw out that existing SBA playbook?
Yeah, that's a really good question. And you are reaching to the essence of who we are, right? So I have been in Winston at the Wachovia Bank, 1973, greatest bank in the history of banking business, and learned from the very beginning this business is all about soundness, profitability, and growth in that order. So how do you construct a system where you're making a 25-year loan to someone that has fundamentally no capital, and you're paying a lending officer up front, and I got to hold the paper for 25 years? Our interests are not properly aligned. So fundamentally what we did in the very beginning was this, in another banking company that I was involved in, we made 504 loans primarily to Hampton hoteliers in Atlanta in the 80s and 90s. And it worked out great. So then you kind of examine the industry, and is it a CRA play? So if the big shot guys downtown can't make a CNI loan, do you send it to Mikey in the basement and slap a government guarantee on it and get some CRA credit? Because, again, when I started, there were 15,000 banks in this country. There are 4,000 today. 15,000 credit unions, there are 4,000 today. A lot of consolidation. What's consolidation? Well, I'm going to buy your bank, and I got to take out 35% of the cost. That's how I'm going to grow my bank. Well, could you take this program and take it out of the basement and scale it across the entire country? So if you think about our business, the banking business, Ray, it's a pretty lousy business. See if I can make my case. Highly leveraged, 10 to 1. High fixed cost business. You're gathering deposits from the butcher, the baker, the candlestick maker, tellers, CSRs, heat, light, utility taxes in a geographic area. You've kind of lost a lot of the business over the last 50 years. Credit cards, gone. Mortgages, gone. Car loans to the captives, gone. So you're going to make either C&I loans or commercial real estate loans in a geographic area. Okay, so you're kind of a real estate play. That's who you are. Highly regulated, highly leveraged 10 to 1.
And it's a commodity of sorts.
Yeah, and if you think about sports for a minute, baseball, 400 Hall of Fame. Basketball, 65% Hall of Fame. Our business, if you're not over 99, the regulators are all over you.
Yeah.
So
Got to be right a lot.
can you take some of that fixed cost out and have a nationwide model? So the SBA allows you to lend to 1,100 industries. So in the very beginning, we basically said, why don't we get the data of who pays you back? So under the Freedom of Information Act, we got all that data in 2007. My 99-year-old man is a veterinarian.
Wow.
And he's still going hard. He finally stopped practicing. Thank the Lord he stopped practicing, but he finally stopped practicing. But veterinarians pay their bills. Dig in. Chicken farmers have a better payment record than veterinarians. So if we can isolate that, and then I'm going to get back to your question, and then we can find people that have run businesses in those industries to sit down with a credit guy and say, this is what the credit box ought to be. And now we got the credit box. And then we tell the sales guy, go get that. And it's going to be approved 100% of the time. And I don't care where you came from. We'll pay you what you've been paying. Now you got to continue to develop that type of loan production on an annual basis. But I don't want any beef between the credit team and the lending team. I want the lending team, and everybody in this bank, and most do, own stock in our bank, because we're trying to develop capital for our families as well. So we don't believe in commissions. And I think that is Charlie Munger, Warren Buffett's buddy who just passed, always said, you show me the incentive plan and I'll show you where this business is going. So that's what we built it on, and we're proud that we did.
How do you build up the conviction of that model enough to where you can go to the regulators and pitch that idea? One industry, nationwide. Where's that conviction come from?
Well, I mean, it's all based on credit quality. So when we have the data and we can say to the regulator, I want you to meet Don Jackson. So Don Jackson's a former CEO of Pilgrim's Pride. He knows something about the chicken business. And let me explain to you how 100% financing to a 28-year-old farmer in the middle of nowhere, Mississippi makes sense for the United States government, for that Army veteran, and for Live Oak Bank. So you need 6 chicken houses. You got to borrow $3 million. The flock check comes from Pilgrim's Pride or Tyson or one of the big companies. You create what is about a 135, 150 debt service coverage ratio. We get the flock check, and then the chicken farmer gets what's left. We've done a couple of $1 billion worth of loans to chicken farmers. So I think you need to look at the cash flow of the business and create a credit box around that with the experience of the domain expert that has already run one of those businesses.
Okay, so interesting. So that initial business plan worked out for you.
It did.
Was there anything in that original business plan that you ended up pivoting away from?
Well, let's take that from the top, okay? And then let's talk about that pivot, which is a little accounting driven. So let's strip down SBA 7A loan from its essence. Follow this bouncing ball. $1 million SBA loan, $750 guaranteed by the government. Sell it at $110. Put $75,000 in your pocket. That leaves you $250 on your books. Not so fast. The SBA will allow you in the early days, which we did, to sell down to 10%. So you're making a loan to a veterinarian. Her debt service coverage ratio is 220. Her credit score is 740. So you can take that 150 conventional loan and sell that to another bank. The accounting folks basically say if you sell that unguaranteed loan at par, you get a 1% fee. Forget that for a minute. 750, you sold that, you got 75 grand in your pocket, you have a $100,000 loan over here. Call it 1 over prime. You're getting 7.5 points, 1% on the 750, 7.5 points on the 100,000. So that's not a 1 over prime loan. That's an 8.5 over prime loan to that veterinarian. And in the early days, when we talk to banking regulators, they're talking about funding and liquidity. Fund what? I just made a $100,000 loan. it's really a $25,000 loan because I made 75 on the first trade, and I'm lending the money out at 8.5 over prime. So I borrow money at, my spreads are like 6 or 7%. It's fantastic. And that worked out great. I mean, we had phenomenal returns on assets, over 4%, phenomenal returns on capital, over 30%, unheard of. Most banks are at 10. The accounting profession analyzes your stream of income, your servicing income. And every quarter they got to revalue that. So as we grew bigger and bigger and bigger, the accounting profession basically looked at that servicing stream and said, based on certain prepayment speeds and certain defaults, that servicing asset goes up $5 million. That's an accounting profit. Next quarter, flat. Next quarter, down $7 million. It is, Ray, accounting mumbo jumbo. My people who look at this forecast in the finance area are going to be very upset with me for saying that. And so we decided to begin to hold more paper at that time.
Mm-hmm.
Then we decided to look at other conventional industries because we had expertise in SBA lending across the country. So about half our book today at $10 billion is SBA and guaranteed loans, and about half is conventional and other concentrated industries.
Before we get into the episode, I want to tell you a quick story. I was at the BDO retreat earlier this year, sitting next to Dustin Baker and one of the Shatterbox learners that he had recruited into the SBA industry. Her name is Sarah. And Sarah told me that she closed $10 million in her first 6 months as a BDO. I look over at Dustin and I asked him, why would anyone hire an $8 to $12 million producer anymore? Sarah is one of many Shatterbox learners who has proven that you can take a smart young person with no SBA experience, teach them SBA, and in many cases, they will outproduce seasoned BDOs right out of the gate. Why are we so willing to hire a mediocre BDO with a 6-figure salary when you can hire your next rock star, someone with unlimited potential, for half the price? You have no more excuse. Shatterbox has created the best learning platform ever created for the SBA lending industry. Join the 20 plus Shatterbox clients who have already taken the plunge on building talent from the ground up. I'm going to leave a link down below just for Art of SBA listeners. So if you want to learn how Shatterbox can help you hire and invest in bright young talent without breaking the bank, reach out and set up a discovery call today.
So obviously we're on a camp. You have a whole campus here, which is beautiful. At what point did you realize it was going to make more sense for you to hire and train people from scratch versus hiring existing SBA professionals?
Well, I think we do both. I mean, back to the theory of verticality, we're in about 40 separate industries, and most of that emanates out of here in Wilmington, North Carolina. And then, frankly, however many years ago, Wells Fargo, as you remember, was the number one SBA lender in the country for many, many years. And as I recall, they kind of had two theses. So they had, 20 or 30 BDOs that were out in different cities looking for high quality credits. And then they had another 100 or so folks in different branches taking referrals from internal sources. And then, as you may recall, there was a consent order from the federal government that said Wells Fargo could not grow their bank, and they had certain other challenges in their retail business. And it was with a great degree of skepticism that my partners finally agreed when I said to them, let's create a R&D department. We have proven the theory of verticality from veterinarians to funeral homes to pharmacies to chicken farmers. Let's see if we can go hire somebody from Wells Fargo that has 20 years experience, that came through the branch, that was trained properly, that is in a different city, looking at different referral sources. Let's just try it. My partners did not want to do that. And I finally convinced them to hire one. And now we have probably 40 different lending officers in different cities.
The generalist team.
The generalist team.
Why was your partner so apprehensive about that?
Just that the success of knowing an industry, having a domain expert.
Right. That's what made you successful in a way.
Yeah,
and now you'd be.
Yeah, and we knew everything about all these. I mean, once you get in one of these industries and you go to trade shows I mean, it is a very, very small group of people that run those businesses. Like when I used to go to the National Chicken Council, a trade association, every CEO of every major chicken company was there every 90 days. So you just knew everybody.
Mm-hmm.
And they were, from a credit quality standpoint, they were quite reluctant to pursue a different avenue. And it's worked out. I think you got to do both.
Well, but early on though, when you're building the verticals one by one, everyone's in Wilmington, right?
Correct.
And I mean, I would say what, like 90% of those people did not have SBA experience when you hired them.
Yeah, that's correct.
So, why do that versus, going out and hiring people, maybe expanding the geographical, area that you're searching for people that already have SBA experience? Because that's what everyone else does, right? I'm going to start a SBA department. I'm going to hire an existing SBA credit manager, closing manager, operations. Everyone's coming in, plug and play, go. You did it a different way.
Well, I just want to do both and continue to do both. I mean, we've been at this, Ray, for 17 years, and we're in 40 industries. An investor could look at me and say, why are you only in 40 industries? There are 1,100 you can be in. Why are you only in 40 cities? I want every great SBA lender to work here at this bank in the United States of America. Why are you on 40? Why aren't you in 150 cities? In my hometown of Lexington, Kentucky, where I'm headed here in a few minutes, we don't have anybody there. That's a town of 400,000 people. Can we not have a lender that knows and understands the SOP, book high quality credits? I think we can, because we are fundamentally different from everyone. I would say that what I'm asking you this question: in the entire market, what percentage of lenders are paid commissions?
I think it's pretty much everyone but you.
There you have it. So if you want to take the heat off your family, if you really want to, and our generalists come here all the time, if you want to be part of this family, if you want to understand what we've done, looked at this the other day. 10 years ago, we were an $800 million bank with $50 million worth of capital. Today, we're a $15 billion bank with $1.2 billion in capital. We've grown the assets 39% year over year and the capital count 34% year over year. Now, if you want to be part of that growth thing, right? Because if you think about every other bank, it's awfully hard to grow in a geographic area. You look at the loan portfolio go do some research on every bank from 10 billion to 20 billion. They're lucky to grow that bank 5% a year. We're growing over 15% a year. So you either want to be part of that, generate capital for your family, have 100% health care, 6% 401k match, and everything that you're going to see here today, or you want to go do what you're doing.
Well, it's interesting because, I mean, you guys obviously started with a totally different playbook, like we mentioned, and almost polar opposite from what had been proven as the model.
Right.
And over the next, I don't know, 6 or 7 or 8 years, you guys became the #1 SBA lender in the country, dethroning Wells Fargo. And you've pretty much stayed there and grown. You guys are, pretty much, I think, just smashed the record for 7A volume. And it's all going back to this unique idea that was started by you in 2007-8. Which part of that business plan do you think has been the most consequential? Is it the theory of verticality? Is it the fact that a lot of people are here in person working? What do you think?
Okay, I'll tell you a story, and I'll answer your question. Kelly King is a friend of mine. Kelly King's retired CEO of BB&T. Kelly came down to see me 3 or 4 or 5 years ago, and we were wandering around campus. And if you have a chance to wander to our parking lot, you will see a fitness center that is second to none. So we wander in the fitness center about 2 o'clock, and there are probably 30 young live oakers in there working out. Fitness instructors, lifting weights, treadmill, all that.
Yeah, McGinley was in there benching 305.
Yeah, right. And he looked at me and he said, do you let them do that in the middle of the day? And I said, Kelly, I trust them and I love them. If their supervisor paints the appropriate target for how they're going to be successful by Friday, by the end of the quarter, by the end of the year, and you're a closer, at Live Oak Bank and you're working 14 deals at once and half of them are real estate and the contractor's yelling at you and the lawyers are yelling at you, the paralegals yelling at you, and you want to get up and go to the gym at 2:00, go to the gym at 2:00. It's okay. Same thing with COVID and remote. Now, as you can tell, we have hundreds of millions of dollars invested in this campus. We're coming to work. I interview every 2 weeks, all new Live Oakers, and they always say to me, this was the 5th try. This was my 8th try. If you want to work remote, Ray, I will do, I know everybody in the banking business. I will do everything I can to get you a job so you can work remote, but you can't work here. Now, if you're in one of those towns and you're, you know, a generalist, that's different. But if you're here in Wilmington, we're coming in here every day.
Why does your credit philosophy start with industry? Because that's obviously one of what you guys are famous for. Why not FICO or why not collateral type? Why is it industry focus?
Well, I think we morph into those other things. We're looking at, you know, more collateral now than we used to. We used to be just a cash flow lender, but my founding co-partner is the best credit guy in the history of the world. And we're, I'd say, very creative lenders. We'll do stuff that other banks won't do. Like it's just not a credit box, loan to value ratio of this, slap the guarantee on top of that. We'll look at most anything.
What about the guarantor? Like, how do you view them? Because the industry is one thing, you can pick good industries, but how do you pick good sponsors to lend the money to?
So you're talking about out of the SBA lending business?
In SBA lending, when you're looking at the actual person who's going to buy the business or the person who runs the business, well, let's say it's a business acquisition, right? How do you look at that buyer of that business and determine if they're going to be successful in buying that business that's in a low risk industry?
You just have to unpeel it. So yesterday, I got the greatest guy in the history of the world that runs the bank day to day, so I have the ability to do what I want to do. So I went to Houston yesterday on a deal with a very young lending officer. Hospice business, ER doctors buying a hospice business. Nice business, $5 million revenue business, dropping 33% to the bottom line. Numbers all worked. But that was not the essence of the deal, and you could not have gotten at the essence of the deal unless you sat in the room with the buyer and the seller as we did yesterday for 2 hours. ER business, coin and money. So secondary source of repayment, makes as much money as our loan amount to buy the business that was in question. So I think it's what we do. You have to go see the prospect. You have to go see the buyer and the seller. You got to go over the budget around the kitchen table. In that building over there, and if you walk through, we'll show you, we have 75 really young people, under 25 years old, getting financial statements every quarter on most all of our borrowers. So we know where they stand.
That's incredible.
Yeah.
No one does that.
Well, that's how you train them to go into a vertical when they're 25 or 24 and then move up the ranks.
It's a way to build a sort of talent pipeline.
That's it.
So did I just hear you say you flew to Houston to meet a borrower on a prospective deal?
I did.
As Chip Mahan, the CEO of Live Oak Bank.
I flew to Houston yesterday. I sat down in a conference room at the Regis Office Center for 2 hours with the broker, with the buyer, with the seller, and we did a deal and back here by 6:00.
That's incredible.
I do that 2 days a week.
Really?
Yeah.
Why?
It's the American dream. I love it. I love being with customers. I love being with these young kids. When I get them on our airplane, so it's 2.5 hours to Houston because we had an 80-knot headwind and 2 hours back. So I have 5 young people on the plane with me for 5 hours. It's fantastic.
That's fun. Well, it's another thing no one does, by the way. And it's like we're putting it all out there, and we've had folks, come on the podcast over the years from Live Oak, like Kay, and you guys are pretty open about most of the stuff that you do. Not a lot of people do it, even though it's worked out really well for you. I find that fascinating.
Fun.
It is fun. Let me ask you this. Do you think, and I'm going to pivot this back to credit philosophy, but adversity, when you have adversity in your life, especially early in your life, do you feel like that shapes kind of who you are as an entrepreneur? And is that part of why you're successful?
Well, I mean, yes. So I lost my father in a plane crash when I was 11, and that changes you, you know. But people often ask, like, what keeps you up at night, right? Nothing, nothing. I try to think about 5 things most every day. And this is not necessarily in order. My faith, that's always tops. Health, my wife, my family, and this business. I mean, business is one part of it, but it's not 80% of it. Or not even 20% of it. It's everything else. We've been so blessed here. I mean, we're sitting in a town with 125,000 people. We sold our hospital. We're the second smallest county in the state of North Carolina. And the people that run that foundation have to give away between $60 and $100 million a year in a tiny town. So if we can be involved in all those things, on top of running a business, on top of creating jobs for 1,050 people, that's winning.
100%. I agree. I think adversity is a blessing, you know, in a way. Do you think it's possible to look for that in a borrower? Like when you're assessing a person that you're lending the money to and you see some adversity? Because I think a lot of banks look at that and kind of view it negatively in a way. Like if you had a struggle in the past, it's almost a blemish. But if you've overcome that, isn't that, do you think that's something you should be looking for as a lender?
So here's what I think about that. So we actually have a client. I don't know exactly what you're going, but he does massive due diligence on individuals. So these days, one needs to be very careful, like what we're doing here. So this is going to be in social media, and it's going to be out there forever, right? So we have a saying around here: you cannot do enough due diligence. So I really want people like this gentleman's firm. If I'm going to lend you money, I want him to do a deep dive on you. Yeah, you got a DUI when you were 17. Okay, got it. But what else is out there? And you can do today massive due diligence that you could not do 5 years ago or even 10 years ago. So I kind of want to know the fat underbelly of, like, when the ox gets in the ditch, what's going to happen here? Are you going to throw me the keys, or are you going to pull that ox out of that ditch?
Exactly. And that's why the in-person site visits come into play because you can start. I mean, can you read people? Like, do you have that ability where you can just tell?
Not any better than you.
Yeah.
Just having a conversation like this, look you in the eye,
It's a-
ask penetrating questions, see how you
Yeah. It's a
handle that.
gut thing at the end of the day.
Yeah.
All right. So I was actually walking into a business the other day. I just got to talking with the owner, and he had said, "Hey, I actually got an SBA loan last year to buy out my partner." And so I said, "Who did it?" He said, "Live Oak Bank." And he said they were great to work with, unprompted. How did you guys manage to scale to this level and still maintain the customer service? Because a lot of the big banks, they don't get really praised for that customer service. What do you know that they don't?
Well, I think a lot of this gets back to technology. So lender, underwriter, closer, servicer. How do you perfect a handoff in all 50 states? So I have been incredibly blessed to have been at the very front of 3 tectonic shifts in technology. So my brother-in-law and I put the first bank on the internet in 1995. And then when we started this bank, I mentioned Neil Underwood earlier, my technical product genius partner of the last 25 years. And we're saying, Anchorage, Honolulu, San Juan, lender, underwriter, closer, servicer, 148 docs to close an SBA loan, real estate, paralegals, blah, blah, blah. How are we going to do that? Are we going to keep FedEx in business? How are we going to actually achieve the only thing that our borrower wants to achieve, which is, am I approved? When are you going to give me the money? So in that previous life, Neil and I bought businesses all over the world. We built data centers all over the world. And then there's this guy, you may have heard of him. His name is Bezos. And he says, I'm pretty good at data centers. You can use mine. Cloud computing, cloud native API first. So could we create a loan origination system on Amazon Web Services whose data center is running 9 nines, so it never goes down and it's always accurate, where we can perfect the handoff between the lender, the underwriter, the closer, and the servicer. So we went out and we cut a deal in 08 with Salesforce.com, an OEM deal. And we began writing code in this bank. We spun that business off. It's a company called Encino that you may have heard of. It's a public company. Market cap of the business is well over $3 billion.
I've used it at multiple shops.
So there you have it. So we did not necessarily think that software was our proprietary advantage, but our people using the software was our proprietary advantage. Now you roll the tape forward to artificial intelligence. And we are in the final phases of perfecting what we have tried to do here for 17 years, which is a full-blown automated credit memo on next generation technology.
Goosebumps.
Yeah.
I love that.
So create an agent that can interview a customer, calculate debt service coverage ratios, create global cash flow, all on the fly. And more to come on that later, but we're close.
Is that with Casca?
It is.
We've had Lucas on the podcast.
We've had Lucas.
Yeah, great guy. I love that guy.
He's
One of
a
a
force
kind.
of nature, Lucas is.
Yeah.
Yeah.
Yeah. He's like a German Steve Jobs.
Yeah, he is. He is. He's something else.
You mentioned the handoff. Why is that handoff so important and perfecting it?
Put yourself on the other side of the trade. You know, you're doing business with Live Oak Bank. We want a seamless communication between, I'm the lender, I'm going to do this deal, here's how we're going to do it. Now, somebody over here's got to do the paperwork. We've got to be completely consistent all the way through to closing and have that transparent. And the technology allows you to do that.
Okay. So you said earlier you put a bank on the internet. Now we're in the AI revolution. So, are we talking about putting banks on AI? Like, what does an AI bank look like?
If you think about what this business is, from transaction processing, I mean, it's ones and zeros. It is, in another vein, death by spreadsheets.
It's shuffling papers all around. We're all just moving papers all around.
That's right. All that's going to go away. These agents have the ability to look at a 100-page tax return and pull whatever data out that you want. So you're not trying to transfer stuff from your head to an Excel spreadsheet and you fat finger this and it goes over to this one and that. All that's going to go away. All that's going to go away. And look, I tend to get overexcited about new technology. And will always want to be first. But as you get a little bit older, it's trust and verify. There are a lot of shiny things, early days of the internet, early days of cloud computing, early days of artificial intelligence. In our Canopy Venture business, we probably look at 3 or 4 of these businesses a day. And these firms in the Silicon Valley are throwing enormous amounts of money at pre-revenue companies, at ridiculous valuations. Some are going to work. Some are going to be massive businesses. Some are going to fail.
Right.
Try to separate
That's the point. It's a numbers game with the venture.
It is. You try to be smart about it.
Interesting. Now, you said all that stuff's going away with the papers and whatnot, but is it going away for everyone? I mean, aren't there banks out there that are not even anywhere near even thinking about AI? Like, what happens to them?
I think it is a bit frightening in this way. So I had the good fortune, as 30 other CEOs, to go to JP Morgan Chase about 6 months ago. And Jamie Dimon was open enough to allow us to bring our chief technology officer and anybody else.
Wow.
And for 6 hours, we had a chance to look at presentations of JPM's top 11 people in the machine learning and artificial intelligence area. These numbers are wrong. But they spend $15 to $20 billion a year on technology. That company has 260,000 employees and 60,000 engineers. Last year, they had like 250 use cases of AI. This year, it's twice that. So then you think about a community bank. Core processors, Fiserv, Jack Henry, FIS. You're using whatever they have to offer. Do you have the budget to go in there and try anything different? And then where does the federal government stand on that?
Right.
As you know, the big five have 50% market share. The top 50 banks in this company have about 80% market share. So it's 50 has 80. That means, of the other roughly 4,000, we have the rest. And where's that all headed? And how do you implement that? It'll be an interesting 10 years.
Sounds like community banks are going out of business.
I don't think so. It's kind of like the early days of Salesforce. Customer relationship management, blah, 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 blah. Well, when I owned banks in Kentucky and Springfield or Harlan and Pineville, we didn't need customer relationship management. We knew everybody in the town. We knew 100% of the people in the town. There are 5,000 people. We knew everybody in this town. So there'll always be relationships. And as long as you have decent products to sell and lend money and, deposit products, community banks are going to have to be smart about it, but they'll survive.
Yeah. No, I agree. There's going to be people that don't want AI. They want to deal with people and they want to be able to go into the branch. And but yeah, I think you will see a little bit more of a separation there where it's going to be looking very different going over here to a big bank or just a technology bank versus a community bank. Now you guys have grown. You went from, one industry SBA lender to you're a bank, you're doing deposits, you're doing other things outside of SBA. But what, got you, that early success was kind of that nichiness. So how do you maintain your edge as you grow into more of a general kind of bank?
Well, I think we just continue to do the same thing. Again, as I say, we're in 40 industries. The SBA allows you to be in 1,100. Let's keep going there. We're in sponsor finance, lender finance, senior healthcare. Let's continue to pick other solar. We're in, really interesting niches conventionally. Let's continue to do that. And then, it's like compounding is a wonderful thing. If we can continue to grow this bank 15% per year and grow our earnings 15% per year, so we don't have to go to the capital markets to dilute ourselves. 15% doubles every 5 years. So if you're 24 and our stock's at 35 or whatever it is today, and you double that when you become my age, your family will be happy. That's the plan.
I have two more questions for you. If one of your buddies came to you, one of your bank CEO buddies, and they came in and said, "Hey, Chip, I want to get into this SBA thing. We're gonna sell the guarantees. We're gonna make the non-interest income, and we want to kind of be like you and have all this success." Like, what's on the short list of warnings or advice that you would give to that friend of yours?
To start a bank from scratch?
No, they have a bank and they want to start an SBA program. They want to scale it, grow it, make the non-interest income. What advice would you give them if they want to jump into SBA?
The water's warm. Jump in. It is the greatest product in the history of banking. A floating rate 7(a) loan is the best asset that anybody can put on any bank's books, period, bar none. But it also gets back to soundness, profitability, and growth. You have to make good credits. You have to take care of your customers. You have to take care of your people, and you build from that.
Okay. So this is, the Art of SBA Lending. So I'm going to close out here with a question about SBA lending. And since you're a disruptor in the banking industry, I want to kind of look forward 10 years. And I just want to ask you, where do you think SBA lending is going, and where do you think it's going to be 10 years from now?
Well, if the past, Ray, is a proxy for the future, the agency's been around since the Eisenhower administration. And, obviously it was a bit different in the Biden administration than it is in the Trump administration. As you know, some changes were made, and there'll always be tweaks. But I think it will be here forever because we're properly aligning everyone's interest. The bank has skin in the game. The borrower has skin in the game. The government has skin in the game. We're creating jobs. We got a massive amount of data on how many jobs we've created in almost every county in the United States. I think it needs to be bigger. We talk about bringing jobs back to the United States of America. We talk about manufacturing. $5 million doesn't cut it, right? So could that be 10? Could that be 20? Again, properly aligning interests. I don't think it goes away. I think it gets bigger and better every year.
It's got room to run. I mean, you have only like 1,000 banks participating in it.
Yeah.
So you got 3/4 of, well, I guess more with credit unions, the vast majority.
And I tell you the other thing, right? So, and I'm the world's worst at the SOP and what's eligible and not eligible. And we have many people around here that are just fantastic at that. Artificial intelligence is going to help in terms of that determination remarkably. So if you can turn that over, well, what's eligible, what's not eligible, to take all the guesswork out, because the worst thing you could do in this business is say, well, it's guaranteed.
Why
and
did I
then
think
and
that?
then the loan goes bad, and then the federal government.
That's the crux of this whole. That's
That's-
what's keeping a lot of the other banks on the sidelines.
That's right.
The uncertainty.
But artificial intelligence will have a dramatic effect on determining eligibility.
Okay, you heard it here, folks, first. So, Chip, thank you so much for sitting down with me.
Ray, it was a pleasure.
All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and The Video Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of The Art of SBA Lending. Ta-ta.